And we're live. Hi, welcome to Interchain FM. We are here with Crisco, my co-host. I'm Chango and Jane, and we are here with Tarun Chitra. Tarun is the author of Why Stake When You Can Borrow, and we are going to talk about everything related to that paper, as well as speculate on what might happen once we introduce stuff like staking derivatives into a proof of stake context. So welcome, Tarun.
Hey, thanks for having me.
Yeah, so the problem statement that we're framing this conversation around is the idea of introducing high liquidity functionalities such as on-chain dexes and collateralized lending into a proof of stake context where staking tokens, which are essentially virtualized ASICs, need to have disincentives from being liquid because it affects the security of the underlying protocol. So yeah, Tarun, why don't you kick us off with the abstract of your paper and how you came about with staking derivatives?
Yeah, so I think the way that this kind of got started, I'd kind of heard of people working on staking derivatives for a while, but I didn't really understand why they would be useful until about February. So I gave a talk at the Stanford Blockchain Conference about staking versus lending, with the idea that, which is sort of a simpler model of kind of what would happen with staking derivatives, where imagine that you are a validator and you have two choices if you're going to be rational. One is you stake your tokens, you lock them up, you get some yield. It's fixed, you know what it is. The other is you put your staked assets into something like Compound or Maker in some ways, shape, or form, and you earn yield, but it's variable, and you're not like quite it could be higher than the staking yield, it could be lower, and you're kind of trying to optimize your portfolio. You say, I have 100 atoms. Do I spend 80 of them in a staked setting and 20 of them on lending? Or do I spend 80 of them on lending and 20 on stake? And, in that paper, I kind of showed that there's some scenarios, there's this kind of phase transitions, think like liquid turning into ice. There's kind of a very sharp transition statistically that takes place where under some conditions you go from almost all of the agents in the system staking all of their assets to suddenly them flipping and putting all of their assets into Compound or some other type of lending product, which isn't good, right? Because, proof of stake currency is as safe as the size of the amount of assets locked. But if people keep thrashing their assets in and out, or like removing them, or like removing like 70% of the assets, the security can go down dramatically. And so I was talking with Alex, who's my co-author on this paper, at SBC, and we were talking about ways that protocols could defend against such a thing. And one of the ways we thought about was, hey, what happens if the protocol is the biggest lender? So imagine that a proof of stake protocol itself, hey, it's running a smart contracting programming language. What if it was also in charge of Compound? So Compound's lending rules were part of consensus. And so it could monitor how much people were putting into these kind of riskier uses of, say, atoms, and say, hey, maybe I should actually increase the staking inflation rate to adjust to what the lending rate is. So the question is, how would you do that? How would you make the protocol sort of the biggest lender? And then in the process of thinking about that, it became clear that staking derivatives are sort of a form of lending that consensus is sort of can be aware of, more aware than, say, a random smart contract, more because it's connected to kind of like the total stake that's locked in the system. And so then we went down this road of saying, okay, let's suppose, under what conditions do you avoid this this sort of attack of people pulling all their assets from the staked component and moving them to lending by having a staking derivative? And, I think broadly speaking, we kind of found like two main results. One result is like as a function of the amount of demand in the system for lending and sort of how frequently people get slashed on average, you get a transition from a period where the stake distribution is very concentrated to where it's less concentrated. And the reason you can think of it as being less concentrated is that staking derivatives give smaller validators a like equal opportunity to certain kind of yield chasing opportunities as larger participants. But also there's a sort of weird risk aversion which naturally occurs, which is, if you're the analog, I guess, in the normal markets is reinsurance funds. So reinsurance funds, they're not very sexy, right? You don't see ads on buses in Britain saying double your money in a reinsurance fund. They say double your money on Binance or Hex or whatever, I don't know, whatever ads you see in Britain. I'm not in Britain, but I've noticed that for some reason, crypto ads seem really popular there. It doesn't make any sense. Oh, I don't know anything about it. But.
And in EasyJet in-flight magazines. That's the other place I've seen them.
There you
go. Europe, for whatever reason.
I feel like Europe seems to have a lot more like traditional advertising of cryptocurrency stuff, which in the US you just like never see.
I think it's because the regulations are less strict
on
what you can advertise.
Okay, yeah, that makes sense.
In some areas.
So so the idea was just like, hey, you can be more. You don't see reinsurance funds being advertised, and that's because they promise a low yield, but it's extremely reliable. Because you would need 500 hurricanes to happen in 1 year, destroying every city for them to go to zero. But people are paying premiums, so there's income earned. But they're not high yields. And so reinsurance is only really invested in by very large capital holders, whether it's sovereign wealth funds or pension funds or endowments. Like people who have a lot of money will allocate to reinsurance because they need some really safe, super safe investments that are maybe a little better than owning treasuries.
Sorry, I might be a little bit dull here, but can you define reinsurance is, am I getting this right? Which is people pool their money into a pooled insurance asset, and then it distributes funds if any conditions are met for funds distribution?
I like to think of reinsurers as base protocols for the following reason, which is insurers sell to consumers, businesses, many different types of users, and they pay out when like some incident happens. A reinsurer is the insurer for insurers. So insurance companies buy reinsurance to say, hey, look, we can only cover with our capital $1 million of damage, but we want to cover 1.5. So what we're going to do is we're going to buy 500K extra of insurance from you, and you pay out only on that. Like if basically we go bankrupt, you cover the remainder. So it's like really the most base level insurance because it's insurance for insurance companies. And I think of proof of stake as like if you're a base chain, it also like, the staked quantity in the protocol is sort of a form of insurance, but it's also kind of this insurance for all of the smart contracts or chains or like I think of those things as their own insurance funds. Like Compound and Maker effectively have insurance funds collected from the fees they're earning. But that's at the application level. That's like one level above. But when I think below, like what's the thing insuring all of those? So to me, in my mind, at least the finance version of it is it's sort of like reinsurance.
So for reinsurance in the traditional market space, but it seems like you could stack almost an infinite amount of reinsurances on top of reinsurances, and it's kind of a house of cards. Whereas in the blockchain context, it's more like high level to low level, where the higher level the application, it would be above. So if there's like a second layer contract that then falls back to the underlying protocol, then there's only like one level of reinsurance.
Yeah. I mean, in practice, there's only one level of reinsurance. There's very little. Anytime there's reinsurance in history, it's blown up. So
right. Okay. So I was kind of thinking in terms of like Federal Reserve lending, but maybe it's not that way.
Yeah. The reason I think of it that way is it's like it has a similar capital structure to staking in my mind. Like the idea that like you put up some capital and the concept of validation here is like someone reporting the oracle that you didn't have any incidents and have money. Gotcha. In some sense. But the reason I think of it like that is reinsurers have capital concentration. Like only the biggest funds can really allocate to reinsurance. Like you're never going to go allocate to reinsurance because you should just go put it in the S&P 500 if you're not like a huge size person or like in Bitcoin or ETH or whatever your strategy is for these more volatile assets. You're going to be better off than putting it in something that's barely over treasuries. But if you're really large size, there's not many opportunities for you to put your capital into. So you need to put them into these less risky things more than a smaller size individual. Gotcha. And this risk aversion is sort of, I think, the problem Zaki likes to talk about of like exchanges taking over all of the staking and then offering people these derivatives, effectively letting them trade on the exchange while they're holding the staked asset. That sort of is you have a similar sort of concentration of wealth effect in staking where, and there have been a bunch of papers on this that show that like if you don't design your block rewards correctly, you're just going to like reward basically the first earliest validators will collect most of the block rewards, or like if your slashing penalty is too big, then you have something similar. And so what we showed was that with staking derivatives, if there's enough borrowing demand, you actually get to this point where people are basically borrow against their stake quite regularly, and sometimes they get liquidated, but each liquidation, and this is in our model, so like each network has a different version, but we just wanted to prove that this could happen. You actually get more equality because the largest holders will oftentimes borrow against their stake, and then if they get liquidated or partially liquidated, their relative earnings in the future go down because their percentage of the total stake has gone down. But you should think of it as like, there's a couple lenses to view this from. One is the staking network is the biggest lender of its own asset. Number two is you can basically dial the risk from like not risky at all, if we want to say like the base currency is the least risky, to super risky. Like I let you borrow almost 100% of your stake, right? That would be bad. Like if I had 100 atoms and the network could issue me 99 synthetic atoms and I default, then the network is holding the bag on those losses, right? So tuning that spectrum is like the key to kind of adjusting risk from like the riskiest, hey, this is like reinsurance, to hey, this is like the casino. Does that make sense? Sorry, yeah. That was a bit meandering, but that was.
So something like a stake. So are you saying that in the future there could be many staking derivatives all acting as various reinsurance assets on top of the underlying asset, which is the insurance?
Yes, exactly.
And there is a certain like window of parameterizing how much risk you're willing to take up to 100% of your collateral.
Yes, and the network can do that. So I think there's a couple ways you could do it. One is you actually do it in consensus. So in this paper, we assumed that the pricing of the staking derivative was done in a like Uniswap-like protocol that is controlled by consensus. So consensus would put all of the transactions related to the staking derivative first and validate them before it validates any other transactions. And that was part of the consensus rules. This might seem like foreign or pushy or depending on your perspective on the sort of libertarian versus liberal perspective, I suppose. But a bunch of protocols already do this. So Celo and Terra already special case their oracles for their stablecoin to be the first transaction. And their oracles feed into a Uniswap-like pool. And the protocol controls its inflation schedule based on the oracle update. And its inflation schedule is adjusted based on it adding or removing liquidity to a Uniswap-like pool. So this is already existing, even though it might seem a little weird that Consensus is running a exchange related to the asset that it's producing. But that does happen. And so basically, by having Consensus be able to control this sort of venue for borrowing and for trading, the Consensus protocol can actually know how much risk it's holding at all times, like the total amount of leverage that it's given out. In the same way that like MakerDAO or Compound know the total amount of leverage that exists. Now, of course, there could be off-chain leverage, but that can't be validator stake if they're locked. So at the end of the day, the idea here is you've incentivized people to stay within the protocol, and the protocol can now act sort of as a bank, allowing certain validators to borrow against their stake. And this all stemmed really from trying to get around the staking and lending thing. Like how would you kind of incentivize validators because they have expenses to pay and all sorts of other things, and there might be better capital opportunities. But I think the connection to DeFi actually comes in that DeFi provides a set of risky assets that go everywhere from like, Compound and Aave, which I'd say are, probably the safest DeFi sort of protocols in a lot of ways, all the way up to, now there's infinite risk protocols, but let's kind of cut off the food coins. But even up to something like Synthetics is a great protocol, but the stakers have a lot of risk, and on March 12th they had a crazy they ate a ton of losses on derivatives because you could think of Synthetics as the ultimate staking derivative. It's a staking derivative on top of ETH. The main token SNX is staked. When you stake it, instead of getting rewards, you mint a synthetic asset with SNX as your collateral. And if that asset's price crashes enough, the SNX holders eat the losses. So like you're staking and you're getting some inflation rewards, but you can also lose a lot. But it's sort of like getting slashed in some sense, but it's getting slashed based on a market price. And that's very much like a staking derivative. So Synthetics, I would say, is like kind of the one extreme. Compound and Maker and Aave are the other extreme. And you should really be thinking of proof of stake staking derivatives in that spectrum in some sense.
Mm-hmm. Do the dynamics of your analysis change if it is possible to move the staking derivative of the staking asset, or I guess even derived derivatives, secondary or tertiary derivatives, off the chain using some kind of interchain protocol or even cross-chain synthetic? Would that introduce different dynamics? Like if, say, people could sell the derivative short, something like this?
Yeah, so we do, in this analysis, we assume there's an exchange where you can, there's sort of the way we design this is assume we have atoms. And so one thing I realized based on the forum post that someone replied to one of the tweets with is that people think maybe we modeled this off Tezos. I think I modeled it off Tezos strictly because Tezos was one of the only proof of stake assets in Synthetics, And synthetics is sort of the pure idealized version of a staking derivative in my mind. So we didn't really model it off any existing designs, and like all the different designs can be quite different. But what we assume, and this is the way to think about it. Imagine there's a Uniswap market, like controlled by consensus, that prices synthetic atoms to atoms, and at any time we make the assumption that it's the most liquid market. So like the most trading of synthetic atoms for atoms takes place on, say, a Cosmos Hub chain. Now, every time someone borrows, they mint synthetic atoms against their atoms, and then they can trade them for fungible real atoms or trade them for fungible, let's say, a stable coin. Let's say like Terra's USD, I forget what the USD Terra, whatever, that thing. So I go to the Uniswap exchange and I say, okay, here I have 100 atoms. I borrowed 75 against them, and now I sold it for, I don't know, 75 USD Terra. So we assume that. So you can kind of go short, but the cross-chain thing is actually quite different. So we don't assume there's lending where you're trying to short the synthetic. And that definitely would change the dynamics, assuming that there was someone who wanted to short squeeze the synthetic version. Because what happens is every time someone, let's say the atom to synthetic, let's say the assumption we make is synthetic atoms are never worth more than atoms. So one atom is always at least worth one synthetic atom. It could be worth more, right? And so every time someone defaults, the synthetic atom to atom price would go up. So like there's some natural price dynamics from people who are like buying back their collateral, buying back their staked atoms, versus people who are like selling to basically because they want some liquidity. But then there's a portion of the automated market making curve that we designed such that when there's a default, the price has to go up. So like the number of synthetic atoms to buy back an atom goes up, which is sort of averaging out everyone's risk. So like each time you take a loan, it's sort of non-fungible. So it's like I have the Chris loan, and Chris is a degenerate borrower. He like always defaults on his loans, and he takes out the max loan possible, and inevitably somehow like he poured coffee on his validator machine and he got slashed. And once he got slashed, he passed through his collateral limit. So like, let's say he had 100 atoms, he borrowed 75. He got slashed so many times that he lost more than 25 atoms that he got slashed on. And then the network kind of reclaimed his collateral. When that happens, the synthetic price has to go up. Like it went from like 1.5 synthetic atoms per atom to like 2 synthetic atoms per atom. And the idea is the market making curve lets consensus look at that price and then remark all the loans. So like when Chris defaulted, maybe Zaki, I don't know. I'm just picking random people. I'm not trying to say anything about anyone's real credit scores. Sorry, I should give a disclaimer. Zaki might be a pretty good borrower, but he wasn't really checking his loan very often, and Chris's default caused the price to go up, and now Zaki is actually in default because he can't buy back his collateral because the price went up. So this is kind of the mechanism we study is something like that, where we're basically like the defaults adjust kind of the price that the consensus protocol uses to mark whether a loan is in default or not.
So,
which is not different than sort of synthetics Oracle. The difference is the Oracle, one of the reasons we think this sort of helps you avoid the Oracle problem a little bit is that if the biggest market is actually on chain on that network, then the consensus protocol can trust it fully because that's the primary market.
And so when you introduce exchanges into this, how do you imagine that playing out? Like exchanges acting as the reinsurance providers?
I guess, well, exchanges would, the question I guess is would exchanges stake, mint a synthetic, and then instead of selling that synthetic on the on-chain Cosmos exchange, put it on their own order book?
Yeah.
And then basically make the, so I agree. I don't, we assume in one of our assumptions that basically the main staking derivative market is the one in protocol. If the exchanges themselves start trying to game the synthetic, there'll be kind of something different would happen. But one thing I will say is the buyers of synthetic atoms are mainly people trying to close out their loans. They're not like people speculating, because they're speculating on a wrapped asset to like main asset being near one. Think of it as like WBTC to BTC. It's like it's going to be mainly arbitrageurs plus people who are other validators, and the only validators who aren't the exchanges themselves who are buying are going to be the smaller ones, and they're probably more likely to go to the exchange on chain because they can like see their liabilities, versus something where you're buying a token that's purely speculatory on like future cash flow. Like the synthetic version of these tokens is always worth less than the real version. So why wouldn't you just buy the real version, right? Unless you're paying back a loan, because your loan has to be paid back in the synthetic atom. Mm-hmm. Does that make sense?
Yeah.
So that was our logic for why that assumption kind of would make sense. But yeah, I guess we didn't write out exactly the behavioral psychology for why that was true.
Do you analyze, so one of the frames by which we often look at consensus security and proof of stake security from the perspective of cross-chain interactions, or from the perspective of like client interactions more generally, is what is the sort of stake which would be lost by a fault which would fool a like client. So usually this means you've exceeded the 1/3 threshold, for example. And now we can't, if you've exceeded the 1/3 threshold, we can't account for evidence on chain in quite the same way, because presumably whoever the 1/3 was could censor. But in Tendermint, for example, we can run a kind of fault accountability protocol to figure out who it was. And conceivably, they would eventually be punished. There's some reasonable expectation that if social consensus can run a deterministic protocol to identify who committed the fault, their assets will get slashed. So in a simple proof of stake system without derivatives, it's straightforward to reason about what that cost is. And you can use that cost to kind of determine what it is or is not safe to use a like client to do. So if you have assets flowing around your proof of stake chain in transfer sizes which exceed the amount of collateral which would be lost, then that's clearly unsafe, right? Because if I can double spend a cross-chain transaction, and I only lose $100,000 worth of atoms, and the value of the transaction itself is $500,000, then there's a lot of reason for some validator cabal to coordinate and do that and split the proceeds or something like that.
Yeah.
Have you looked at how the existence of derivatives would or would not change that cost? It's like not immediately clear to me how to calculate that when you have derivatives involved.
Yeah, that's a really good point. I think the hard part with that, assuming that the consensus protocol on at least one of the chains is aware of the total amount of staking derivatives minted. So this is why I think it's very important for consensus to have access to A, the loan book, like how many staking derivatives it's issued, and B, the price. Like if it can trust those two, then you can deal with kind of what you're talking about, because at least one chain will just say, this is the price we're marking everything at, and this is the max amount of state we're willing to allow to cross, because its passes or is below some risk threshold as a function of the loan value, collateral limit, and like price. But all of these things need the lender and the exchange to be for like synthetic token to real token to be really dominantly in liquidity on chain. Now, my claim is that, again, this is more of a behavioral psychology answer than like a rigorous answer, is that big exchanges aren't going to really want to or maybe they won't even necessarily understand why they should really support a lot of liquidity on like synthetic atoms to atoms. Because they want to build their own synthetic atom in theory, right? They don't want to use the in protocol one, because that's the one that they can like do all this type of stuff of like, hey, you can trade it on more fungibly. We don't have to check on chain all the time, etc. So the people who are smaller validators, or I just think are more incentive aligned to use the on-chain one. Especially now that like people are getting comfortable using on-chain finance, or at least it seems like it.
Right. I guess the other aspect of my question, which I realize may be hard to answer on the spot, I just wanted to get your first impression of it, is that it seems to me like if derivatives are involved, it may no longer be possible to consider. It may no longer be possible to treat all validators as equal. I mean, if all validators have the same amount of stake locked up, there are no derivatives at play, then you know exactly what they lose when they get slashed. And it's a function of what stake they have and the percentage. So it's like, it's a constant function of the fraction of the network which an individual validator is. So it's very easy to reason about, because it doesn't matter who the validators are. It doesn't matter what other assets they hold. But if different validators have different loans out, I guess my question is it possible for validators who are going to like want to execute this attack or something, and presumably they could do this all very quickly, to take out a bunch of loans or something like this, or sell some derivative short or something right before they do, and thus substantially reduce their incurred cost when they get slashed?
Yeah. This all boils down to like pricing something. Pricing the total value at risk in the cross-chain transaction and making sure that the staking derivative plus the margin, some margin of error, is less than the value of the cross-chain transaction somehow. Like, I feel like you have to add a bunch of invariants like that. Otherwise, you're not going to be able to do this. Now, you might be able to argue that, hey, how can we know a priori what the value of the cross-chain transaction is? Because like maybe it's some like really big smart contract interaction, and I don't know, I can't guess what the end state is, or like it's a flash loan that like is very large. I would argue that if you trust your cross-chain, the amount of stake bonded in your cross-chain transaction, the total value of that, to be an estimator of an upper bound, then you already have an upper bound estimate, right? Like if like the people executing the cross-chain transaction have to commit a certain amount of stake per unit transaction, then you can use that to price how much derivative exposure you're willing to take.
Yeah, I mean, from the theoretical angle, just getting the ability to calculate a bound what you should let transactions be would be very helpful. I mean, particularly large cross-chain transactions, presumably can wait for additional assurance, be that time or notarization into some other blockchains, which the recipient chain is also running light clients for, something like this.
I guess I'm thinking of it in this like sort of more relay model, where like there's like some set of relayers who split the fee, but they have to put up some capital to earn the fee. And maybe this is definitely the wrong model for IBC, but I'm just trying to like.
I see. Well, here I'm not necessarily concerned about relayers who have collateral on a bridge. I'm assuming that
Yeah.
the bridge is using the light client. So the only signing entities who have collateral at stake are the validators of the main chain, who are staking the native asset, potentially getting a synthetic derivative and like doing whatever they want with this synthetic derivative within the bounds of the protocol. And the question is, which I think it's kind of the question you were already answering, but the question is just what logic can the protocol institute, maybe with the aid of a on-chain market maker at a known oracle price, and the ability to measure the amount of outstanding loans, and even the ability to control value flow over cross-chain transfers. Can the protocol, from that perspective, provide to users executing the cross-chain transfers some pretty strong guarantee that at least the amount of collateral guarding their transfer, or which would be lost if their transfer were not spent, exceeds the amount of their transfer, like as a function of what transfer they try to execute?
Yeah, exactly.
Because for IBC to work, the protocol has to provide the guarantee. Otherwise, you shouldn't be using it. So,
sure. Well, I mean, otherwise you're just trusting.
Right.
Implicitly. Yeah, I think the only way to do it is to really somehow. All of this stuff stems from the idea that you need the protocol to be the biggest exchange. But as we've seen in ETH, that's very possible, right? Like ETH WBTC is more liquid on Uniswap it was more liquid by almost 2x than Binance last week at one point. So like with the right incentives, I think the protocol can actually, provide quite a bit of liquidity to these systems. Another form that's not quite a staking derivative, but I'd seen in Tezos land, and the code I saw that actually got released didn't have this feature, but I thought it was kind of interesting. I mean, you have to do a lot of testing to figure out what the right parameters are for this, but imagine if you have 100 atoms staked, and there is you can earn transaction fees from people trading atoms to synthetic atoms if you put some of your stake into a Uniswap pool. And what you do is you split the transaction fee that you earn. You split some fraction of it with the block producer who executed a block that your transaction fee was through, so that they're not incentivized to kind of like take advantage of the fact that you're double using your stake. So it's sort of a form of staking derivative, but it's the same as if you took a staking derivative, minted a staking derivative token, like minted synthetic atoms against atoms, and then put it in a Uniswap LP pool and then earn fees. But it's doing it atomically versus like having to do it in two steps. And so I think I saw a Tezos Uniswap design that was talking about doing that, where basically, and the incentive, there was certain reasons that you wanted to incentivize the block producer to not like do a malicious fork and sort of front run the transaction. So all this goes to say that I think there's a whole space of like, how do I merge stake capital with other DeFi yield opportunities that can be used to help make the consensus protocol in control of the biggest liquidity pool and the biggest lending pool. Because if you can get to that state, you can start doing things like what you're talking about, of like, you can trust those as oracles for the IBC measurement, like for kind of a predicate that says like, this is a allowable size transaction.
That's interesting. So if I may just frame what we've just been talking about in these last few minutes, it's essentially figuring out on the spot how we would mitigate the risks of validator extractable value on the Cosmos Hub within a cross-chain staked paradigm. So
exactly, it's basically that, yeah. So there's benefits to there's like social benefits to the chain for doing this in terms of like deadweight loss to that goes to validators only. I just hate VEV because that has another meaning in physics. So like, which is vacuum expectation value. So I just kind of like seeing it as an extractable value thing is kind of weird. But yeah, it's basically disincentivizing that by splitting the profits with other validators who didn't win that block, like splitting some fraction.
Yeah. So this seems like a unique. It would be a unique problem for Cosmos compared to every other proof of stake protocol, because everything else is sort of a singleton, right? Like an application specific VM. Whereas in the Cosmos context, if we're saying the canonical chain where most liquidity is happening, if that were the hub and it is IBC connected to a lot of different chains, then this kind of VEV would be a unique problem to Cosmos Hub.
Yes, but look, if the IBC participants, both in the senders as well as the validators, are okay with trusting the Cosmos Hub as the source of, as basically the oracle, but an oracle where it's non-custodial, right? Because like everyone can pull all their, it's like Uniswap, it's like Compound, it's not like Binance, right? If people are willing to do that, then I don't know, to me that seems good enough. I presume the app chains already will be sharing some percent of validators with hub validators anyway, and that overlap does kind of.
Yeah, I mean, it seems to me like it may depend to some degree on the assets, the degree of overlap with hub validators. Yes, I mean, there's probably no reason not to trust the issuing chain, the issuing validator set of an asset to also be a price oracle. Like it doesn't,
right?
You wouldn't,
but
you wouldn't be able to get a better price oracle.
I think model. The issuer to Atom's price is probably going to be on like a hub-like thing, not the separate app chain, though, right? I don't know. It could turn out differently but my intuition, the reason I would say that that's not true, the only case where that's not true is Binance or like a centralized exchange, right? Because like BNB is way more liquid on their app chain than it would ever be on the hub. There's just no doubt about that at this point, right? Because you can stake it on the exchange or stake it on the exchange where they give you fees, right? So, sorry, CDFI is like literally the worst thing I've ever heard in this space.
That's the first time I've heard CDFI. It sounds like
it's a made-up Binance
parody acronym
for centralized, decentralized finance. Yes, exactly. Anyway, my point is like when the examples where I can think of the app chain to Atom's liquidity being dominated on the app chain are centralized exchanges or like exchange chains. But app chains that aren't exchanges, I don't see why they would. I don't see why they would like also want to run extra transactions to like maintain the state of like the Uniswap or like whatever market making mechanism they're using, versus like hub. Whereas keeping on the hub, like as long as there's overlap between the hub validators and the app chain validators, there's way more liquidity for Atoms already there in pools, and people will reallocate some of that Atom to the pools of Atom to app chain. It just seems like it's more natural, but maybe you guys know better than me for that. So that don't let me. I don't actually know. I don't know how much the validator sets overlap and stuff.
Well, at the moment, there's a fair degree of overlap in practice, but it is not identifiable by the protocol. So the protocol cannot provide guarantees about that. There's some ongoing research to work on what we sort of term cross-chain validation, where some kind of spectrum exists between completely sovereign chains with disjoint validator sets and complete shared security, where you run several, usually then they are called shards, which have the same validator set or rotating subsets of the same validator sets. And in between those is a spectrum where you have some but not complete overlap. And the protocol, if this is managed in protocol, can reason about what the overlap is and then potentially calculate.
Well, I think the amount of liquidity on the app chain versus the hub is going to be converged to some number that's dependent on the overlap. Like Binance chain, zero overlap, right? They only validate their own chain. They don't, and that's why they can have all their liquidity captured on that chain to some extent. So there is some natural reasons that validators who are earning assets both in the issued asset and in atoms, wherever they can overlap, that would be the natural place to have an exchange. But that's just I guess my view when I talk to validators is I don't get the feeling that they're trying to do the most complicated way of exchanging these assets. And like you could imagine that like if they're an exchange, they will do something complicated to maximize their fee revenue. But validators, I don't get the feeling, other than kind of maybe the Huobi, Binance, OK, stuff like that. I don't get the feeling that they're very good at like profit maximizing in this way. They like really just want to run the infrastructure and get paid like a dividend.
Right. Well, some of this,
Yes.
I agree. As an evaluation of the state of things, I agree with you. Although I think some of it is dependent on the difficulty with several protocols at the moment to automate asset transfer of staking rewards, which means that you have to touch hotkeys to move your assets, which just introduces this huge operational risk. That potentially will change because there's not a great in-protocol reason for it unless you're trying to create friction. Maybe intentional friction is good. When that changes, I would expect more automation both on-chain and off-chain.
I mean, I've always wondered why not have rewards get paid to like a liquidity pool, like a Uniswap style pool, and you get like the full reward if you keep it locked in the Uniswap pool, and you get like 90% if you don't. It's almost like a yield farming incentivized pool, except it incentivizes you to keep your rewards separate from your stake, and you can keep only the rewards hot, but the stake cold. And you've incentivized it also so that people don't keep trying to sell their rewards instantly. But it's very analogous to synthetic yield farming because synthetic yield farming, right, is like you take the token, you mint an LP share, you take it back to this contract, and you stake it in that contract. And by staking it, you get a higher share of rewards from synthetics inflation. This is almost exactly the same. So it's just, I think it would actually help the hot and cold wallet setups, but I haven't seen anyone propose it. But I think that might be a way to kind of ameliorate some of these problems.
How do you imagine, I guess, yield farming evolving in this proof of stake context?
Yeah, I think it's going to look not so dissimilar to what I said. It's going to be things that incentivize the liquidity for the main asset to stable coins and other issued assets that are in the network to be concentrated on chain and non-custodial. I think from a both financial setting, that's a way to eat into centralized exchanges kind of commandeering the profits, because they're never going to be able to keep up with the rebates that the network is going to be able to produce to some extent. And then I like the type of thing that like Terra and Akala and Polkadot are doing of like letting you borrow against future block rewards. So you're minting staking derivatives that aren't against your stake, but against like expected future block rewards. So if you get slashed, it's not dissimilar. One is just backwards looking. You're borrowing against like previous income, and one is against future income. But they're both affected by slashing, because if you get slashed and you lose a block, then like your reward is less, and now your loan is less collateralized, stuff like that. But that's something that happens in normal finance in terms of like invoice refactoring and stuff like that. And I think that that's like a pretty good way to give people liquidity that isn't just based on their current stake, and it keeps them locked into the network. And you could think of that as a form of yield farming in some sense. If the rates are different, like if the rate for borrowing against the future income versus past income is like there's a big spread, that spread represents a sort of yield farming. The other thing is sort of this liquidity thing. I think it's actually kind of funny that Tezos, for what it's worth, like kind of came up with this incentivized pool thing, even though they didn't realize it a long time ago, like in 2019, but like they never built it. And then Synthetics kind of accidentally built it, and it was clearly the right thing to do for them. That's like what made their token. That's what made so Synthetics is the poster child for this. Why? So Synthetics has a purely synthetic stablecoin, SUSD, which is just an Oracle stablecoin that tells you the price of SUSD to SNX. But there's no collateral backing it, basically. Like there's sort of collateral backing it that you need SNX to mint SUSD, but there's no bound to getting liquidated. Like the prices of those can be arbitrarily disconnected. And SUSD was unable to keep its peg. So Synthetics made the liquidity mining contract that every single one of these DeFi protocols just copy pasted. In fact, most of them kept the copyright thing that says like made by the Synthetics team, blah, 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 blah. Free software license. They kept it there as a form of like proof of don't read my code. I just copy pasted the Synthetics thing, which was audited. And so the Synthetics contract was to make, the reason was what you would do is if you prove that you put SUSD and USDC or SUSD and DAI into Curve, into a pool, you could stake your pool shares and then you would get extra SNX inflation. And that was the first type of yield farming. That's exactly this thing of, hey, take your block rewards from staking and put them into a Uniswap pool that Consensus controls, so that Consensus control is in charge of like the biggest liquidity source for the base token. So I think that's one really big avenue for staking. It of course has more technical hurdles than on the app layer. Kind of like this hot and cold wallet thing is something, I mean, everyone's using MetaMask, so I don't really think anyone cares about that in ETH land. But there's that, and I think this kind of borrowing against future income is actually something that is much more amenable to staking than it is to DeFi, because like my future income is extremely variable in DeFi, right? Like the interest rate volatility is huge, whereas the interest rate volatility in staking currencies is low when denominated in the base currency. So you can imagine doing loans against it that are safe. And so I think that's the type of thing you take advantage of. And the other form of yield farming, this is the one I think that's like most important, more on a like societal level in some sense, is like figuring out how to yield farm for like anonymity set creation, for like zero knowledge proof generation, like really figuring out how to come up with a good incentive to get people to be proof generators and like relayers of proofs and stuff like that. I think there's some exciting work on figuring out how to parallelize these proofs, like what Aleo is doing with Dizek and stuff like that. But I haven't seen anything pretty compelling that's like there has to be some type of yield farming mechanism to get people to donate, or not donate, it's never really done, to lend their coins to increase an anonymity set or to incentivize proof generation, etc. Because I think if you have an economic model for creating privacy in layer ones, the proof of stake layer ones, it's going to be very hard for those to be censored. And it's just like a really good feedback loop that we've never seen in this space.
Speaking of incentivizing proof generation, one of the ideas I had in the past, which I called Supernova, which is validators would act as like full nodes of the chain that they were basically acting as oracles for, and then the incentive would be that they essentially yield farm like a new token, for example, that then they would only get payout for as a result of providing proofs, and that's like their one job.
Yeah, definitely. I feel like Aztec at one point wrote a blog post about doing something kind of like that, but I haven't seen anyone who's like really like, either someone is secretly doing something like this, so you're on the right track, or there's some reason it doesn't work, which there's like some weird, with a lot of privacy stuff, there's always this trade-off that like whoever is the most successful at farming kind of doxes themselves. And you have to somehow make the game incentive compatible without doxing the highest earner. Right? Because like if the distribution of rewards concentrates to the person who makes the most or best quality proofs in whatever metric you're using, then like you can look at that address and say like, oh, we should just go like send the FBI to them if we can identify them from their one Binance transaction. Right? So that's the one thing where like NIM also has something like this where they have like in their mixnet, they have like a staking mechanism, and I still haven't ever gotten a good answer to like how someone doesn't get doxed by being like a good validator node, like being too good of a validator node or like proof generating node or anything like this. So somehow you need to hide the distribution of stake in the yield farming token at the same time. And that seems that's where I'm lost personally.
Yeah.
Right. Private proof of stake is tricky and it's dangerous.
Right. Exactly. I mean, that's at the end of the day, if you want yield farming for privacy generation, you need private proof of stake, single secret of leader type of election type of stuff. But I don't want to be responsible for writing the code for that. Like, you know, it's a lot of liability.
So you talked about back in the day, you know, all the way back in 2019, when Tezos had come up with this yield farming idea without intending to. Can you give some more background about that? I find that really interesting. You know, I wasn't really paying.
I mean, I wasn't either. So we kind of were sharing an office with Tezos, and or still are. Well, we still are technically, but I don't know what it means to share an office anymore in 2020. Yeah, there were just people talking about doing this. Like people who are like Tezos developers were just like, oh, we're going to make a Uniswap clone. And they released the Uniswap clone actually like a couple of weeks ago called Dexter. But they didn't have this yield farming thing. But they were talking about this like way back last year, before I don't even think Compound had hit $100 million yet. Like they were like, this was like April or something or May. It was quite early. I was like really impressed because at that time when I first heard it, I was like, no validator is really gonna want to do this. And it was for the kind of Chris's concerns of like, oh man, my key management gets a lot harder and more annoying and stuff. But I guess in DeFi, people just don't care about key management. They're just like YOLO MetaMask, like
my yams.
Yeah, exactly. I mean, I have yet to find any of the large yield farmers that I know who don't use MetaMask and Ledger.
Yeah.
Like there's nothing more than that. There's not like custody solution, right? It's just like you know, it's like my Ledger is connected to my laptop.
Yeah. Yeah, MetaMask had gained like an unprecedented number of new users after yield farming kind of took off.
Yeah, it's crazy. 1 million monthly active users that's almost like normal startup level.
You're right.
Yeah. Right? Like
I think that's
it is kind of for the entire blockchain. So
yeah, but still, I don't know. 1 million is like a pretty big, I guess.
Something.
Yeah, that's incredible. That's like it's basically the first crypto app that breached like mainstream usage. If we're going to say that the threshold is 1 million active users.
Yeah,
that's a lot.
Yeah, definitely. I can't think of anything that's come. Actually, the thing I don't know how many people use Coinbase or Binance though. That they must be in the millions too, right?
Yeah, but they're not like a crypto app. Not like a killer.
Yeah, they don't count.
Yeah.
Look, I had to tell my cousin who was like, I bought Bitcoin on Robinhood. Now I know everything about crypto. That like, you know, hey, maybe you should try Coinbase first before you get too cocky. So,
yeah,
you know, I feel like a lot of people think they're using crypto by using Coinbase.
Yeah. But yeah.
This is why yield farming is great, because like I actually think like if you can actually provide rewards that are higher than what people are getting from saying that they're using crypto on Coinbase, you could actually have way more liquidity for your assets on chain. And then it's just like life is way easier for all of these IBC like things to use. Once they have oracles, it's just so much easier. Like you can actually talk about pricing these things. But I, you know, when I say oracles, I don't mean to knock Chainlink, because you know what, they faked it till they made it, and the thing, like, the engineering quality has gone up so much. But you know, I just like these on-chain oracles that are like usage driven, like, you know, like dexes that are like really liquid and like really hard to manipulate. Because like, you know, that's a source of truth that's just like independently verifiable, which I just don't think anyone in crypto really cared about until, you know, last year, ironically.
So I still have a hard time kind of reconciling like a decentralized oracle versus just a centralized trusted one. You know, like why is it better?
I guess the thing is, if you use Uniswap as an oracle, right? And let's suppose that there's a market for two tokens, X, A, and B, and Uniswap is the largest market for trading A and B on Ethereum. If I need the price of A in terms of B, if I use Uniswap as an oracle, I'm assuming that there are enough arbitrageurs present and enough people who want to earn yield on, but also want to own A and B that exist, that it's extremely expensive for them to manipulate. Because the cost that it takes to manipulate Uniswap or other constant function market makers is sort of square root of the percentage that you want to manipulate it by. Why that result is true is a little bit weird, but there's some math reasons for that. But the fact that I can give you a precise cost of corruption, like how much you would have to like buy up of A versus B or remove liquidity in terms of A versus B to cause the price to move, I think that's like a much better guarantee that this oracle is like the real price in whatever sense real means to you. Like, because like when I say whatever sense it means, let's say you trust an exchange a lot because like every time you go there, they execute your orders correctly, but they don't have much liquidity. Or like you only own Korean won and you can only go to like 5 exchanges or something. To you, the notion of the true price is the one that you can access, which is, you know, your local thing. But in the case of a Uniswap like thing, there's no guardrails to who accesses it. And the cost of manipulation is a function of the total number of trades and the liquidity in the pool. So it's just more believable because of that, I guess, versus like a centralized oracle is like, well, you know, but you know, you can. I agree that decentralized oracle does have its own issues. It's not like it's perfect, but
yeah, thanks for that. That makes sense. Yeah, cool. Do you want to wrap up real quickly because we are at the 1 hour mark?
Great.
Typically, how long these podcasts go for?
Sweet.
Thank you so much, Tarun.
Thanks.
It's great to chat.
Yeah, definitely.
I'm hoping that we'll end up with some formal analyses of staking derivatives vis-a-vis IBC.
Well, you know,
then maybe I would feel more comfortable about not crying wolf or whatever whenever someone wants to.
I mean,
I look at DeFi on Ethereum. I guess, you know, the impression I get is it suffers from Twitter selection effects. But whenever I look at DeFi on Ethereum, it's just absolutely terrifying. And why would anyone want this anywhere near proof of stake?
Yeah, I agree. But I do think that there's a trade-off of concentration of wealth, right? No matter what.
Yeah.
So the question of how much concentration you're willing to tolerate as a community.
But there is also that high of chasing liquidity that stakers should not have to like sit out on or miss out on.
Yes. Yeah, definitely.
Yeah.
Yeah.
Well, anyway, cool. Thank you
good.
so much, Tarun. This was
Thanks.
such a fun conversation to have. I hope everyone here had a good time diving deep into the technicals, because we certainly did. And so, yeah, stay tuned for the next one. The next Interchain FM is going to be episode 8, and we are inviting RAC, the musician, on to talk about NFTs. So, yeah, thank you everyone who stayed on for the live portion. We're going to rip out the audio and distribute it through Simplecast in its podcast form. So stay tuned for that. Thank you for everyone listening to the recorded version later on. Bye.
Right.